Hi, everybody. Welcome to our third webinar of the AgriMinds Africa Challenge. We've had already two webinars. The first was on how to position your agribusiness to secure credit financing. And then we had a second one on how to deliver an effective and persuasive agribusiness pitch. And so today, as a follow-up to the first webinar we had on positioning your Agrostartup or agribusiness to secure financing, we have with us Jerry Parks of Injaro Investments. And he will be given a series 2 of this lecture on how to position your Agrostartup or agribusiness to secure equity financing. So I just think I'm going to briefly introduce Mr. Parks. He's the co-founder of Injaro Investments. And as you would have seen in our creatives, it's a firm that has managed over 60 million held in equity and credit funds that invests in agribusinesses or in SMEs across Africa. Injaro has actually benefited over 2.5 million Africans and contributed over $60 million to local economies. Prior to Injaro, Mr. Parks worked in various consulting and investment banking roles in the UK and the US. He holds an MBA from the Wharton School of the University of Pennsylvania. And so if you're joining us, we are glad to have you. And we are absolutely confident that this webinar shall impact your agribusiness with all the technical knowledge that you need to transform and to grow your agribusiness. So we'll take about a 3-minute pause. You can share the link, inform your friends, get them in, and the webinar starts exactly in 2 minutes. Thank you for joining us.
Good afternoon, everyone. And first of all, I'd like to say a big thank you to AgriMinds Africa Challenge and the ESO team for inviting me to participate in this webinar. I hope that it will be helpful to all of our budding entrepreneurs or agro entrepreneurs, and that what I share today will at least help improve your approach for raising equity and give you something, a new edge that you did not have before. So I think I've been muted. So I shall go straight into it. The topic is how to position your agro startup or agro business to secure equity. And we'll first go through a quick intro on Injaro, just a recap of what we do. Then we'll talk about how to make your business investor ready and have a bit of a discussion about the fundraising journey and how you can navigate it. We'll talk a little bit about finding investors. I think a lot of you have some good ideas, but we'll just try to put some more structure around how you do it. and then provide a few tips on how to handle due diligence for those of you who will be fortunate to get to that stage. And then we'll do a quick recap and then open up the floor for questions. Now, in terms of what I'm aiming to do, I want to share insights that you will not find in a textbook. I'm sure through this community, you're learning a lot about the technical elements of finance, how your business should be valued, and how to keep accounts, etc. I'm going to presume that other people will give you a very good coverage of those topics. So I'll try to give you a bit more of a focus on the softer rather than the technical aspects of fundraising. Hopefully, given that I've been an investor in Africa focusing on agriculture for the last 10 years, I'll be able to present to you my viewpoint, what I see from the perspective of an investor who is faced with thousands and thousands of applications for equity funding. And hopefully this insider perspective will give all of you an edge when it comes to your own fundraising journey. Now, to help frame our thinking around how we think about fundraising or equity fundraising, I just wanted to share two quotes from one of my favorite authors who wrote 7 Habits of Highly Effective People. And the first one is, begin with the end in mind. So what is the objective of your business? What is the business trying to do? And in the particular case of this presentation, the end that I'm talking about is the market, the people who are going to pay for your product or service. Begin with the end in mind. Now, the second quote that I'm borrowing is, seek first to understand and then be understood. And underlying this is the whole idea of trying to look at the world from the viewpoint of the investor. If you remember nothing at all from this presentation, if you always remember to try to look at the world from the eyes of the investor, from within, and walk in the shoes of the investor, that alone will help a lot in how you position yourself to raise equity funding. All right, so that's a quick run through of the objectives. So very quickly about Injaro. Injaro has been around since 2009. We currently run 2 funds. One of them is an equity fund that invests in SMEs, agricultural SMEs in West Africa. That fund has deployed over $33 million in 14 countries across 5 West African countries, mainly Francophone West African countries and Ghana. As Stephen said in the beginning, beneficiaries of that fund are close to 3 million people, mainly smallholder farmers and people on low incomes. We also run a credit fund called the ABC Fund, which provides mainly loans to agricultural SMEs, farmers, organizations, and agripreneurs across Africa. This fund has a slight bent towards youth and women and towards improving rural livelihoods. So this is a fund that was launched in 2019 and which we co-manage with a Luxembourg-based fund manager called Bamboo Capital Partners. This fund has made 4 investments in Ghana and Cote d'Ivoire and has a rich pipeline of targets that we're looking to help across East and West Africa. This second slide highlights a few more of our achievements. I shall not go through too many of them, but in the spirit of tuning your minds towards putting yourself in the shoes of the investor, we all know that human nature suggests that people talk about the things that are important to them. So hopefully, in looking at what we've put on this slide, you start beginning to get an idea of what different investors might think is important. So we're talking over here about things like the revenues generated per dollar that we've invested, revenues generated by our portfolio companies per dollar that we've invested. We're talking about the number of dollars, the amount of dollars generated in local sourcing. And what we call local sourcing is a business that we invest in turn buying from other producers in the local community. And then we also think about the beneficiaries, either through direct jobs, people who become suppliers in the local, in the value chain, and customers of the businesses that we invest in. So these are some of the things that we think about and when we're tracking the impact of what we do. But basically, this slide summarizes our track record in West Africa over the last 10 or so years. So now let's have a quick reminder of why we find agriculture interesting, or literally trying to frame the opportunity. And I think it's important to do this because to a large extent, investors and entrepreneurs or business owners are partners in trying to resolve one of Africa's largest challenges. How do we feed our growing population in a way that is financially sustainable? And I think what this slide tries to do is to bring this whole, the big picture together, so it becomes clear exactly how we are working together or how we need to work together. So in terms of impact, which a lot of investors care about these days, about 65% of Africa's population is involved in agriculture. Therefore, it stands to reason that anything that you do in that sector has the great probability of positively benefiting a lot of people. Now, within this population, 60% are smallholder farmers. So this kind of suggests that if you want to diversify the number of suppliers you have for any business that you have, or secure your supply for a processing business, you need to consider how you can include smallholder farmers. I'm not saying that that's the exclusive solution, but chances are if you include smallholder farmers, you're very close to increasing the diversity of your suppliers and therefore de-risking your supply chain. Now, in terms of the profit potential, Africa has the majority of the world's uncultivated arable land. In addition to this, our agricultural yields are roughly, for some grains, etc., are roughly half of what they are, in some cases less than half what they are in other parts of the world, like Asia, North America, and Europe. We have the enviable position of having one of the fastest growing populations on the planet, therefore more mouths to feed in the next 10, 15, 20 years. Actually, I believe we need to more than double our agricultural output just to make sure that we can feed our people by the year 2050. And then you also probably are aware that Africa imports a lot of food. So, people will quote figures anywhere from $35 billion to $60 billion of food imports into Africa per year. So this means that there's, from a business perspective, there's a clear opportunity that people can tap into to create value and supply to a growing population. Then on the investor side, which is my side of the table, we note that in spite of agriculture's contribution to GDP, which is close to 20%, commercial banks are financing it to the tune of less than 4%. And I think that number, even though it looks like an old number in this presentation, has held pretty steady and is quite consistent across most African countries. So you put all of these things together, then you see that there's a clear investment opportunity or business opportunity, but there's also a financing opportunity. And I think there's a financing gap of more than $65 billion that needs to be provided to ensure that Africa can meet its food production goals to avoid starving its people, right? So you put all these things together and there's a clear opportunity for investors and entrepreneurs to collaborate to actually create value in the agriculture sector. All right, so now that we've established that there's a scope for collaboration, for a win-win collaboration between investors and entrepreneurs, well, let's switch gears a little bit and talk about different stages of business and the type of capital that is appropriate for that stage of business. It's very important to know this because you need to make sure as an entrepreneur that you're asking for the right thing to the right person. You're asking the right person for the right thing, because that increases your chances of success. You've probably seen a lot of these categorizations before, but let's run through them very quickly. So the first stage is a startup, where most of the time where you just have an idea, your revenue is zero, and literally you're waiting to take off, right? The next stage is when you've probably started business, revenues have started trickling in, but you're still a pretty young business at less than 3 years old. The growth phase is where, in most cases, we're hoping that your revenues are beginning to exceed your costs. So you're beginning to skirt on the fringes of profitability, and your business is generally more than 3 years old. Then finally, you're at the mature phase where revenues far exceed costs, so you're nicely profitable. Ideally, still growing, but maybe at a slower pace. And generally, we are looking at businesses in that area of more than 5 years. Now, for each of these phases of growth, there's an ideal source of capital. When you're the startup, the preferred source of capital should be your personal funds, friends and family, and the type of funding should ideally be equity. We find a lot of businesses in Africa trying to raise debt at this stage. It is a wrong type of capital for this stage. In the early stage, and by the way, for every stage that you go to on the right, the sources of funding from the prior stage can also still invest, but you can't take money from the sources of funding to the right, all right? So if you're in the early stage, you can still take some capital from family and friends, but then you can now introduce a new type of investor in the form of venture capital funds, angel investors, and some NGOs and foundations. Again, we're still looking at equity at this stage of funding. Now, when you get to the growth phase, you can now start talking to private equity investors, impact investors, and some specialist lenders who can lend to you on friendly terms, longer term loans, sometimes concessionary interest rates, etc. At this point, you can start getting some more flexibility in the types of instruments that you're considering. And then when you go into the mature phase, which is what most big businesses in your various countries are, then you can look at buyout funds, commercial banks. You can list your shares on the stock market. You can list a bond in the bond markets, and you basically have a very broad range of financing instruments available, right? So it is very important to remember to ask for the right people, the source, for the right type of capital at the right time, at the right stage of development of your business. Now, and I think this is a slide where we really need to make sure we're absorbing what makes a business attractive for investment. At the end of the day, this is almost like a matchmaking process. When we're talking about equity investment, some people describe it as a marriage with a predefined date for divorce. But let's put the divorce bit aside for the moment and think about it in the terms of a marriage. It means you have to make yourself attractive. And what is it that makes you attractive to an investor? So the first thing is that you should be operating in an established and growing market for your products and services, right? So at the risk of stating the obvious, you don't want to be, in 2020, you don't want to be in the business of producing fax machines, right? Because the market for fax machines is not growing. And it's not one in which there's going to be a bright future. So you don't want to be in the market for faxes. You want to be in the market for some product where the people who consume it, the number of people who consume the product is increasing. And hopefully the amount that they consume per capita is also increasing. And your business has access to that market and a credible pathway for producing to supply that market. Now, operating in that market is just the first precondition, but the next step is that you need to have a well-developed process and system for delivering the products and services at a competitive price. All the words in bold over here are very important. So for instance, knowing that Europe consumes a lot of cut fruit and that there's a growing market for it due to increased concerns about health, it just forms a basis for considering a business. But what makes a winning business is one that has a well-developed process and system for delivering that cut fruit to the market at a price that makes it competitive with all other people who are trying to do the same thing, and ideally for other potential substitute products, other healthy foods that people could use as a substitute for your product. And the reason why this is important, the reason why it's important to focus on the process and system, is that in many early stage businesses or many agro businesses, at least this is what I've seen, there's a lot of dependency on people. There's very little focus on creating a repeatable machine, a repeatable process or a machine for delivering the products and services. And the more system-based thinking that we have, the more attractive our business is. The next piece that makes a business attractive is having a team of committed and talented individuals, ideally with a track record of succeeding together. Everybody wants to be part of a success story. And another very important reason why a team is important is that over-dependency on one person is a business risk. If I go and invest in a one-man show and the founder of that business decides for whatever reason they don't want to do that, they don't want to be involved in that business anymore, or God forbid, they pass away, suddenly the money that the investors put into that business is at risk of not being recovered because there's a reliance on one individual to actually deliver the results, to deliver the market. Now, with a track record of success together, also very important, just having a team in place is not enough. Can you demonstrate that the team has actually succeeded at what it is that you say the business is going to do? If they haven't succeeded at what it is the business is going to do, have they succeeded together at doing something else? These are all very important questions from the perspective of the investor. The fourth point around good corporate governance and professional management is linked to the idea of having a system. But the most important element over here is the point about ensuring that the business is being managed in the interest of the entity, the business as an entity which is separate from the owners of that business. And having a board of directors that includes independence is one way of ensuring that you're governing in a manner that puts the interests of the entity ahead of the interests of the owner. In Africa, there's a very large prevalence of what we like to call lifestyle businesses that have been set up to feed the owner. Now, a business that has been set up to feed the owner is not appropriate for investment coming from a professional equity investor, because that professional equity investor is looking for the business to thrive, and by the business thriving and creating profits, that investor will also make money. So this is a very, very, very important point. Last but one point, a demonstrated ability to beat the competition and become a market leader. When an investor invests in a business, point number two, we want to see that process and system for delivering products at a competitive price. We don't want that quality to be a flash in the pan. We need there to be a continuous quest for improvement to maintain that market leading position and to consistently try to push the bounds of performance. Because just because you're a market leader doesn't mean you should stop over there and say, yes, now I'm number one, I don't need to do anything else. If with that mindset, you're very likely to be beaten or disrupted by new entrants into your market. So we want to see that mindset of wanting to remain a market leader. The final point is the integrity of the owners of the business. Depending on the type of instrument you're investing, whether it's equity or debt, you want to know that you can trust the people that you're dealing with. Are they going to ensure that all the proceeds of the business come into the company's accounts? Are they going to do side deals to take away profits from the business to the detriment of the investor? Are they people who keep their promises? If they say they're going to execute strategy A, are they going to execute strategy A whether you're looking or not? There's a saying in the world of investors that you need to be able to do a deal without. You have to be able to believe that you can do a deal without a written contract for it to be worth doing. So the integrity of owners is very important. However, this is also one of the hardest things to establish, because here we are as investors looking at companies that looking at owners and founders that you do not know from Adam. How do you even establish whether they have integrity? So when you're trying to look at things from the viewpoint of the investor, this is one of the things you need to consider. How do you demonstrate integrity when faced with an equity investor or someone who's about to provide equity for a business? Now, on the left side, you see an arrow that says this should be your process for developing a bankable business. And it's worth commenting on that for a short moment, because there are many, many cases where people come to us with business plans where they focus more on the production side. That, okay, we can produce, I don't know, butternut squash in Ghana. We can produce sweet potatoes in Ghana. We can produce tomato in Nigeria. And then when I start asking them about where are you going to sell the products? Do you have any offtake agreements? Do you have any, what price per unit will you be selling at? And then people will get a little fuzzy and say, oh, once we produce, we'll sell. Oh, there's so many people buying in the market. And this is because they probably started from the production end of the equation rather than starting from the market. And this is a free tip that I'll give you. If you start your business with guaranteed offtake agreements for 2 times the amount of produce that you can output from your business, you increase your chances of raising equity funding significantly. I mean, that's just having those offtake agreements from credible buyers increases your possibility of raising equity financing significantly. So, and unfortunately, I find that not people come to us first, try to raise money, and then only after we've given feedback, then they go and look for the off-takers. But I would really urge everybody who's trying to start a business, focus on where you're selling, how you're going to sell first, even before you start putting the ink on your business plan. Because if you've established that part first, then you increase your likelihood of having a business that has an established market. Always start with the market. This is what I meant in the beginning when I said begin with the end in mind. The end is the market. So always start with the market. Be very, very certain about that before you start building your business plan. So I'd like us to do a little, go through a little case study where you act as the equity investor, right? And the output of this, and my friends Stephen and Derek are going to run a little poll where you tell me whether you'd invest in this business, right? So just vote yes, I'll invest, or no, I won't invest. I mean, I personally think that it's a very promising business, but don't be biased by what I'm telling you. So this is an idea for the creation of a tomato processing plant in Nigeria. All right. The local manufacturers have been shown to have a margin of between 17% and 35% gross margin. Tomato paste imports into Nigeria, $1.5 billion per annum. So there's an established market. So when I talk about starting the market, here it is. All right, there are people in Nigeria spending 1.5 billion per year on tomato paste. So why should we import it? Let's just produce it locally, right? Now, there's a ban on the importation of fresh tomatoes. So, no other person can import fresh tomato into Nigeria. Nigeria has a high urban population, which is growing, one of the fastest growing populations in Africa. Tomatoes can be cultivated all year round in Nigeria, so your raw material should be quite certain. High demand and repeat sales tendency. We all know our West African dishes. I don't know of any West African dish that doesn't include tomato. All our mothers and cousins and sisters, whenever they're going to cook tomato paste, they need it, right? So there's strong demand and there's growing demand. We can see who the competitors are, Gino, Derica, and others. These guys have a lot of market share. Why should we let these foreigners import product into this market when we, the locals, can produce and make money? All right, so this is what the business owner is asking for, $35 million and 3 months of working capital. They believe that they can pay back in 3 years. They've got a strong market in place. They're planning to build relationships with hotels, restaurants, supermarkets, and stores. And they've got the full factory capacity that they need, etc., for the production of the finished product. So even though they're going to start production at 70% capacity utilization, they're very confident that within the first 3 to 5 years, they'll be at close to 90% capacity utilization. So based on this, if you were an equity investor, would you invest, yes or no? That's the question. So I'm checking to see if we have any results. So I'm waiting. I'll just pause a little bit while we get your votes in. yes or no. This is a very simple one. You get to be the people with the money for a minute. Okay. So Stephen and Derek, do we have some votes in yet? Okay. It seems like it's a split decision. Great. So we've got the votes coming in, and this was an easy win for the yeses. We've got so far, and we don't have all the votes, but based on what we've counted so far, 26 yeses and 12 noes. Now, this is where I miss the old world where this would have been an interactive session, because I'd have loved to hear I'd love to hear why people are saying no to this great opportunity. However, I mean, let me also share with you, based on looking at the same opportunity, what an equity investor, or how an equity investor might also look at this, and possibly our reasons for the decision that we would reach. All right, so from an equity investor perspective, one of the things that we would look at is the yield, right? To produce tomato paste in Nigeria, you need to think about how you can produce at a price that is competitive with the imports, right? Now, let's say I'm assuming Gino and Derica are Italian, right? And let's look at the yield on the tomato yield in Italy, 65 tons per hectare, compared to Nigeria, which at best is about 7 metric tons per hectare on average. Some people may be doing better, some people may be doing less, but let's say on average it's 7 metric tons per hectare. Now, what this means is that if we just use a rough ratio, Italy produces tomato at 9 times cheaper than Nigeria. Therefore, if Nigeria is producing a ton of tomato at, say, $50, or let me use an easy number, at $63, then it means Italy is producing it at $7, which means that the cost per unit of the raw material is 9 times cheaper in Italy than it is in Nigeria. Now, that means that if you're a tomato paste producer in Nigeria, your chances of being competitive with the imported tomato paste are very, very, very slim. You might argue that maybe the transportation cost from Italy might cover that gap, but chances are it will not. So right from the beginning, although you have a great business plan, one that could create jobs locally, as a business, right from the beginning, you're almost set up to fail unless you can do something about your raw material yield, your tomato yield, okay? So this is just an example that I'm giving where you're going to see a difference in opinion between what an investor thinks and what the founder of a business thinks. I think maybe some of the people who said no have actually seen examples of failed projects, probably like the example that we've identified in Ghana. In Ghana, there was one Techiman processing complex established, which literally failed because, in my view, because the raw material was too expensive. And that resulted in side selling. It resulted in side selling and also a more expensive product for the factory. So this is just an example, and it kind of ties together what we're talking about, that to make yourself attractive, you need an established market, which we do have in this case. But second, you need a process and a system for delivering the product and service at a competitive price. And that is what is lacking in this particular example, and why this business would not be attractive to an equity investor. So how will we approach our fundraising process differently after this? Or what can we do to enhance our fundraising process? First, let's talk a little bit about the fundraising journey and how it plays out in the market, right? So for most of us, the first step in the fundraising journey is we prepare the perfect business plan. All right, we prepare the perfect business plan. Once we've done this, we present it to an investor, and if they're interested, we go into due diligence. If due diligence is successful, we now negotiate on terms. Are they going to take 20% of our business, 30% of our business, 40% of our business? Will they be around for 3, 4, 5, or 7 years? We negotiate the investment terms, right, with the investor. Then once that is done, we receive the money and we celebrate because life is good. Suddenly, all those years when we were struggling and we couldn't pay ourselves a salary, we had all these arrears for our suppliers, we had to beg people to work for us for free and we'll pay you later. All those days are over. now we've got money, we can celebrate, right? This is, and this is the view that, or this is a view that a lot of entrepreneurs have, whether some may admit it, some may not, but from the investor seat, this is how we see a lot of people behaving. And when you speak to commercial bankers in Africa as well, they'll tell you many times people will come begging for money, we need a loan. Once they get a loan, the first thing they do is celebrate by buying themselves a very nice car or doing something similar, which is not necessarily linked to the business. So what I want to do is propose to us a different approach, or a more holistic approach to raising money, and also challenging the idea that the fundraising journey starts with a business plan. This is another thing that we need to really remember. It doesn't start with the business plan. The journey of an entrepreneur, the fundraising journey, is actually the journey of entrepreneurship, which is slightly different from what most people are talking about, or most people think. So let's look at that different approach. So the first step, I would say, is, as an entrepreneur, because this is the journey for entrepreneurship rather than a fundraising journey, develop some marketable skills. Become good at something, anything, whether it's technology, agribusiness, accounting, finance, being a great mechanic. Become really, really good at something so that you have a skill set to bring to the table for the setting up of a business. Then make some money from those marketable skills. When I'm going through this, I have to keep on reminding myself, I need to say why. Okay, so the reason why it's important to make money is that, one, you get to save some of the money, and then two, you start creating a financial track record of earnings for yourself, right? Everybody wants to partner with someone who has a positive financial track record. But I think the more important point over here is, and I probably should have mentioned this in trying to make a business attractive. Every equity investor wants to know that their partner, the person they're investing in, has got what we call skin in the game. They've also put some money at risk. Now, how do you put money at risk if you haven't saved any money to put at risk? This is why it is important to try to save money from your prior jobs to also put at risk, and create a financial track record so you can actually prove how much money you have put into the business. This is very important. Then you start working on your business idea, right? Again, I'm going to say this again, work backwards from the market opportunity, right? And in this phase, while you're developing the business idea, you could potentially start getting some money, especially because you're working in the agriculture space. You probably know more than I do that there are organizations, the foundations, the NGOs that are willing to support people in the very early stages of developing a business idea. Now, when we think about working backwards from the market opportunity, i.e. from where your business can sell products, you can also think about the market opportunity in terms of providers of capital. If at this stage you're also looking at NGOs and grants and foundations to look at what types of ideas they're willing to support. Today, we know that people are very, financial inclusion is one of the things that people care about, how we get access to the unbanked. How do you include smallholder farmers in the businesses that you're doing? How do you include women and people and underserved communities in what you're doing? Because if you can think of a way of including these ideas, these concepts that investors find attractive into your financially sustainable business model, you're increasing the number of people who are going to be positive or attracted to what you're trying to build. So think about the commercial side in terms of the market, but also think about how you're marketing your business to investors and how you can start making it attractive from the bottom up, even as you're architecting the business from the foundation. All right. And I think I probably touched on this just before. Start researching investors who are suited to your types of business and start making some initial contacts. At this point, you're not trying to raise money. You're trying to get to know the investors better so that you have a better understanding of what they want from an investment opportunity. All right. So again, we are taking a step back and starting that fundraising journey a bit earlier than most people would normally do. This point is also very important. Africa is a continent of where most people have preferred to be solo entrepreneurs. They own 100% of the business. They're the accountant, they're the marketing manager, they're the COO, they're the CEO. They do everything pretty much themselves. Now, I'm proposing that given that you have a skill set, the multiple skills I referred to earlier, it would be good to find partners with complementary skill sets, people who know how to do things that you don't know how to do. Now, this is important for more than one reason. One, let's say you are a great farmer. If you're able to partner with someone who's a great marketer, then you don't need to pay someone to do marketing in the early stages of the business, because someone with an equity stake in the business is already helping you to do that. So that's the first reason. It helps you save money because you're bringing in people with other skill sets. I mean, in principle, if you are able to bring together as shareholders a group of people who can do everything that the business needs, you wouldn't need a lot of money to start with. So that's the first thing. But the second reason is important is that working with a partner proves that you are marriageable material, right? I almost hesitate to make this analogy, but a 50-year-old man who has never been married before is a worse marriage prospect than a 50-year-old man whose wife has passed away, who's a widow. Because that widow has already proved that they can be in a long-term relationship with another person, but they happen not to be married now simply because the wife passed away. Now, if you are a one-man or one-woman business, and that is what you've been all your life, for me coming in as a potential investor, one of the big questions I'm asking myself is, can you even work with anybody? All right. So this is a very important point to consider early in your business or your entrepreneurial cycle. Partnership, very, very, very important to consider. Now that you've got a partner in place, if you've decided to go for one, you refine the business idea and start pitching it to the first source, the ideal source of capital for a startup. Remember, very early on, we said if you're a startup, you should be talking to friends and family about bringing in capital. So present it to friends and family and be open to them critiquing or helping you to fine-tune the business idea. Don't go along the mindset. Don't go along with the mindset of I know everything and nobody else can have any good idea. At the end of the day, these people could form part of the market that you're trying to sell to. So as you're refining the idea, be open to taking on critique, suggestions, and fine-tuning ideas for improving the business. But at the same time, talk to people about raising money. This is the first time your business is going to be faced with talking to someone who isn't a partner about raising money. So take advantage of this opportunity to learn from the process. Learn about how people push back on things. Learn about how people will make suggestions. Learn about the conditions someone might try to impose for them to give you money, etc. And I'll reiterate, even as you are refining the business idea, maybe testing it out with the market, keep meticulous records of your operational KPIs, right? What yields of tomato am I getting yield in year 1 versus year 2? How many people is it taking me to work this piece of land? How much is it costing me to produce every single ton of tomato? Keep all these records, because these are all records that an equity investor would want to look at in the future to establish what the track record or the growth pathway has been for that business. Right, so this is a continuation of refining the business idea. Whatever resources you have, your personal resources, the resources of any partners that you have, the little cash that you have available, start the business. A lot of people come up with a business idea and they write the business plan and they want the money before they'll start. My recommendation is start small, but think big, but get started, because it is only through doing that you actually learn and that you can refine and make the business better. So get started using whatever resources you have and aim at starting to generate revenue as early as possible. If you've picked the right market, if you picked a product that has growing demand, as an established market, this should not be too difficult to do. If you're not getting to revenue quickly, there's probably a problem with the idea that you've chosen or the way that you're implementing. Right? Then when you've started generating revenue, you start marketing the business to investors. It is always easier to raise money when you're earning revenues than when you're not. I'm not saying that you should never have a startup, never try to raise money using a startup. It is so much harder to raise money as a startup than after you've started generating revenues, because the revenues prove that there's a market. That's the point I'll leave you with. Okay, so, so that was the alternative pathway for building the business. Now, after you've started building the business, sorry, let me go back. After you've started generating revenue, then you prepare a business plan, the perfect business plan. I'm saying perfect in very loose terms, but at this point, you have more information about all of the key performance indicators of the business, the challenges that you're likely to face. You'd have come up with solutions for addressing the challenges. You'd have had feedback from the market, the end customer, around what is likely to work in terms of sales or product features. So now your business plan is going to contain a lot more substance. You'll be better prepared to answer a lot more of the questions that a discerning investor is going to ask. Then you present the business plan to the investor and go through the path that we discussed earlier. All right, receive the money. But here's another change. When you receive the money, you do not celebrate, because it is only now that the real work has begun. An equity investor, when they bring money into your business, is hoping to double, triple, or quadruple their money. And that doesn't come by sitting on the couch and doing nothing. This is when the real work starts. Everything that you thought that you've done in the past, which was work, is going to be multiplied by 5 or by 10. All right? Everything is going to be scrutinized. Everything is going to be challenged. There's always going to be new goals. And when you meet those goals, the equity investor is going to say, why don't we push even harder? And this is all part of the process of creating value, making your business more valuable, growing the revenues, growing the profit line, making it more efficient in terms of cash flow generation, so that the business will have more value. And that is only the beginning of the real work. So that is, yes, you can celebrate in that you have the opportunity to grow your business, but the mindset, the mode you should be in is work, 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 work to create value. And then the final step, which is married to the point I made about putting yourself into the shoes of the investor, is ensure that your investors make a good return. If you do this once, where investors have backed you on a business idea and they've made a good investment, you have pretty much created a perfect track record that will make your business more attractive than the next. There's no business more attractive than one that has actually, or there's no entrepreneur that's more attractive than one who has taken money from investors, created value in their business, and helped them make a successful return. After all, what is the purpose of investing if it is not to make a return? All right, so this is how I think we should be thinking about the fundraising journey. Okay, coming up to an hour. Now, finding investors, I shan't spend too much time on this because I know most of you have a fair idea of how to do this. Everyone knows how to use Google, which I think is a very first step. So you search potential investors. And these, for agro businesses, these are the kinds of search terms you should be looking at. Foundation plus agriculture plus Africa, foundation plus agriculture plus Ghana. Look for NGOs that are looking to invest in or support projects in Africa. Look at impact investment platforms. If you want a list of private equity firms that invest in Africa, go to the Africa website. I think it's africa.org. This has a list of a large number of private equity firms that invest in Africa. Not all of them invest in agriculture, but there are profiles of all the firms on there. You can read about what they invest in, ticket size, preferred countries of operation, etc. All to make sure that by the time you're contacting them, you're speaking the appropriate language. The second important thing is when you go to people's websites, look at the words and the language that they're using. Try to understand how this links to the objectives that they have. And make sure that when you're engaging, you are using, you're mirroring back language to the extent that this is true for your project, right? Don't just use words that don't have any bearing on your project simply because it's a cool thing to do. Investors will see that through that very quickly. But if you are doing something that is aligned to what the investors want, but you're using a different label, it is the smart thing to do is to change your label to match what they're saying. It just makes communication a lot quicker and a lot easier. Then make your business visible. I think you guys are already pretty good at that. Use social media, attend industry events. There's one happening, I think, next week called AGRF, which in the past was an in-person event where you needed to travel to a different country to attend. This year, it is virtual. If you can get on there, it discusses agriculture issues. There's something called the deal room on there. So you can log on there and get in touch with investors, engage with them to consider investment in your company. Obviously, look out for incubators, apply to business plan competitions, do anything to make your business visible. And you can also approach investors directly. We'll discuss a little bit about how to do this more effectively before we come to the end of this presentation. All right, so here are a few tips. First of all, don't just tell your story, provide evidence. Investors are all about evidence. So, and where can we find, and we're talking about independently verifiable evidence. What you tell me as an investor, I cannot take as gospel. I need independent verification. You tell me that you sell, what do you call it? You sell 1,000 tons of tomatoes per year. Okay, I'd like to verify that. Show me accounts to prove that you've actually received the revenues for that. Show me the delivery invoices that you've delivered, that you've actually delivered the stuff to your clients. And let me go and talk to the people that you've sold to and let them confirm to me that they've actually bought those tomatoes from you. Provide evidence. The extent to which you can provide evidence, the more you can provide evidence, the easier you make your communications with investors. The second thing is make your communications concise and tailored to each investor. Going back to the point about the lingo and the language, if your message is straight to the point and touching on the things that are important to them, you cut through a lot of the crowds and you get straight to the decision makers a lot easier. And then also don't ask questions that could be answered by reading the info on the website. All right, so think about this almost in terms of you're applying for a job, right? What would you put on your CV to make sure that your job, if there were a program picking your CV from a group, it would pick yours rather than the others. So keywords, conciseness, straight to the point. And then if you go into an interview, would you go and ask questions about, I'm going for an interview with Barclays Bank. Oh, so I'm into the interview and ask, oh, so what are you guys into? Which sector do you guys work in? Wrong question. You're not getting the job, right? So if you're going to contact investors, make sure you've done your homework so you're not asking any silly questions, because anything that proves that you've not done homework in one department, in the view of an investor, suggests that you've not done the homework in another department. Investors are the quickest people to judge. So make sure you don't do anything that makes you yourself get judged the wrong way. Insider tip, okay. Now, I just thought it would be worth sharing an example of these communication tips with you. These are real emails that we've seen coming through our inbox. So here's an example. I'm an entrepreneur with an agribusiness that deals in snails and mushrooms. I want to expand my operations. I need any more information on how you can be of help and next steps for me to take, as I believe I meet the criteria spelled out on the website. Yeah, this is one of those emails that will be received by an equity investor and will be ignored. I hope, and I don't know if people in this crowd have sent an email like this. Not because there's anything bad about it, but because there are thousands and thousands of emails that look exactly like this. And for me to be able to respond to this, I have to do work. You're asking me to provide more information on how I can help you. But on my website, I've told you what kind of work we do. And then you're asking me for next steps. To me, you're asking me to do work. Contrast that with this one. Similar thing. They're telling me so much. I've highlighted the things the keywords that I'm looking for. 5 years experience means that you've got a 5-year track record. Check. You have consulted my website. Okay, check. and you believe you met the criteria, great. Oh, and you've even mentioned which of the funds you want money from, perfect. You've told me how much money you need, excellent. You've told me what you're going to use the money for, great. And then you've started attaching evidence. You've put in a business plan and audited financial statements. This email will get a response. It will either be a yes, or, well, it won't be a yes. It will either be a no, either, okay, ABC fund has fully invested, or the amount you're asking for is too much. But it will get engagement from the team of people that is looking at applications, because they can look at the evidence that you presented and very quickly tell you whether or not they can take you to the next step. Make sure your communications are tailored. Provide evidence, don't just tell the story. This is what we mean by that, right? The email on the right will get a response. The one on the left will be ignored. Okay. I'll leave that on there for like 30 seconds so you can just have everyone can have a look and just compare the two a little bit. All right. So now I just wanted to give you a little bit of a bonus by talking a little bit about due diligence. You've probably all heard about due diligence. So I just want to talk about why it is needed and just give you a few tips on do's and don'ts before we bring this to an end. Now, based on everything that I've said before, you know, it is clear that equity investors are going into a marriage and therefore need to understand what they're getting into. All right. So this is what due diligence is about. We need to get a full understanding of the business, its track record, and the future opportunities. And we need to also determine whether we can work with the people behind the business. And I think that, again, in the view of putting yourself in the shoes of the investor, remember that the money that most people are putting to work, that are investing as equity, is not their personal money. Most investors, professional investors like ourselves, we are custodians of other people's money, and we do not want to lose the money that they've entrusted in our care. So due diligence means we have to ask a lot of tough questions. We have to ask a lot of uncomfortable questions so we can fully understand what we're getting into, in the hope of reducing the risk of losing other people's money. So I'll skip the banks part since we're not talking about credits today. So, and here, let's go straight to tips. So the do's: respond promptly and accurately to information requests. I think that is self-explanatory. Be honest and open. Remain pleasant and have a positive attitude throughout. I confess, as an investor, that we ask a lot of questions that you're going to find intrusive, especially if you're a one-woman or a one-man business, where all the decisions have been up to you. You never had to explain why you're doing anything to anyone. And the business is very tied to your personal livelihood and your personal wealth. You know, an investor can ask you a question like, how much of your net worth is invested in this business? And you say 20%. They'll say, okay, give me proof of your net worth so I know that this is 20%. And suddenly you're asking, why do you want to know what I own and how much money I have? It's none of your business. Well, for an investor who's trying to establish how much skin you have in the game, it is a very, very valid question. So at first glance, it seems like a very, very intrusive question, and you might even get angry that they're asking that question. I plead with you, remain calm, remain pleasant and helpful, and just get through the process. It is part of what you need to do to get into the marriage. All right. The other thing I would say is due diligence can take a long time. So always make sure you start preparing for due diligence and even for investment way before you actually feel you need the money. This is why it is very important to do financial forecasts in your business so that you can tell that, oh, in 9 months' time, I'm going to run out of money. Let me start fundraising now. Or in 18 months' time, I'm going to run out of money. Let me start fundraising now. Don't wait until the bank account is running empty and say, oh, wow, we need to start raising money. Let's go and start talking to some investors. You'll find yourself, it will just take a lot longer than you expect, and you'll get angry at the equity investors for taking too long. So always look for money before you actually need the money. Insider tip. All right. And this I've touched on already. The fundraising journey doesn't start from the point you prepare the business plan. Good corporate governance and good management has to start from when you create a business so that it is in place and there's a track record of this before you sit in front of an investor. So the other thing is, in terms of the attitude, is to embrace the due diligence process as a learning opportunity. You're going to have a lot of your ideas challenged, a lot of suggestions, a lot of recommendations coming from equity investors. And I think you should look at this as almost like free consulting. If you speak to 3 different equity investors, they're going to give you so many different perspectives of your business that if you take them on board, you find that you can actually improve your business even without taking the money of the equity investors. So coming at this with the right attitude, with a learning and open-minded mindset, you have a very, very good chance of getting valuable nuggets that can actually improve your business, even outside of taking on the money. Now, the don'ts: don't hide information that you think is negative, and don't want to manufacture positive information to deceive investors. This is the quickest way to end the fundraising process. As equity investors, we understand that businesses go through hard times. We understand that you're going to have some loss-making years. And we understand that no business is perfect. Just like a marriage, no human being is perfect, but people get married all the time, right? So it's the same thing. You don't need to hide the information. Let us see all the information and let us make the decisions in spite of, or even with the benefit of knowing all the pluses and the minuses. Second, don't refuse to provide information. I'm saying over here without good reason, but anytime you refuse to provide information, you create the impression of being closed, of being secretive, of not being able to have an open partnership with another person, which cuts to the core of the equity investment relationship. And try not to display impatience with the time taken for due diligence. This is a reflection of the prior point about having the right attitude or remaining pleasant. And also, don't try to play one investor against another. If you put yourself in my shoes and you're trying to play me against another investor, in most cases, personally, I'll just walk away. But in some cases, if you've hired a financial advisor and it is clear to everyone that there's a bidding process where people are competing to make the best bid, that is very different. But if you're constantly going back and forth and say, yeah, these people offered me X, can you offer me more? And going back and forth between 2 investors, it doesn't leave a pleasant taste in the mouth, and you can lose some investors in that process. So just a few tips on what not to do during the due diligence process. So just to round off, it is important to know what type of capital is most appropriate for your type of business so that you're asking the right questions to the right people or the right investor types. Second, build a business that would attract investors. Remember that process starts from the market. Begin with the end in mind. Third, get your message out there, make your business easy to find, all right? Put in a lot of effort to making your business visible. Be proactive, contact investors directly as much as you can, but do this with well-tailored messages that demonstrate how much research and homework you've done before making contact. Finally, be prepared for the due diligence process. It would be a shame to have gone through all the effort in building a great business, etc., only to have everything collapse because of a bad experience that an investor will have during the due diligence process. Now, if you get all these things done, I hope you will be able to secure the capital you need with these insider tips. So with that, I bring my talking bit of this presentation to an end and open the floor for any questions.
All right. Thank you so much, Mr. Parks. This has been extremely insightful. We've been monitoring closely the comments and, of course, the questions that have been coming in. And, you know, someone just said, I think he's called Bolatio Abiodun. He said, you are making reasonable points on this webinar or this seminar. Another person has indicated that you've touched on aspects that were, you know, pretty much relevant to his business and he's benefited extremely. So I'm going to go straight to the questions. We have Patrick Misendefawi, and he's asking if due diligence is successful. You mentioned we need to negotiate investment terms. Now, he wants to know how many terms are accepted by investors. So that's exactly his question.
How many terms are accepted? So this is not a very easy question to answer. But like with everything in life, a negotiation works best when you are prepared. And this is where the knowledge you build in some of the other webinars is going to be important. Things about how your business is valued, and what type, what I think it's mainly around, most of the discussions will be around the value of the business and about control, right? Now, if you're prepared, you can give good reasons why you are opting for a certain value of the business as opposed to another value of the business. And then on the control piece, if you're prepared, you can also make the case for why you should have more or less control. Now, if the investor if you have a good business, and I think everything comes down to making your business attractive. If your business is very, very attractive, the investor is likely to agree to more of your terms. If your business is not very attractive, then they're not likely to agree to a lot of your terms. So at the core of it is, have you done enough to make your business so attractive that you can actually call the shots? Let me give you an example. Today, Warren Buffett, who runs Berkshire Hathaway, doesn't have to agree to any investor terms. He just says, these are my shares, you buy them at the price I say, right? Because his business is extremely attractive. But if your business is not attractive and you're struggling to take on money, then you have to be more flexible in terms of the terms that you insist on, in terms of that you insist on the investor meeting. So that's the best, I think, way to look at it, I think.
All right. We have Asibi Heathrow, didn't indicate country. Do you streamline investors to suit your business?
Simple answer, absolutely yes. And that is the kind of proactive mindset that would help everyone, right? So if you should think about what the investor brings to the table as well. So if you have a choice between investing, of taking capital from a fund, from a generalist fund, a fund that invests in so many different sectors, versus a fund that invests only in the agriculture sector, and I'm not saying this because I'm biased, if you have an agribusiness, go for the fund that invests only in agribusinesses. This is because that investor is more likely to have a network of experts, a network of contacts that can be helpful to your business, right? They probably know a company that can buy the products that your business is trying to sell. They probably know a consultant who can fix a problem that you have. And they probably have these details on their phone. So that investor would be miles more important or helpful to you than an investor that has done one agricultural investment in the last 10 years. So definitely be proactive about the type of investor that you want, and make sure that their values are aligned to your values.
Okay, so we have Victor from Kenya. He's asking, how do I know my business plan is worth presenting to investors?
Well, so I think I'm going to go back to the fundraising journey again, right? If you follow that systematic approach from starting small, getting in partners, selling it first to family and friends before you go to a professional investor, you will be collecting information about the quality of your business plan gradually over time. But if I had to really simplify the answer, if your business is earning revenues and you're generating a profit, chances are your business is investable. Now, in that case, even what is written in the business plan is not that much of a deal. The thing that the investors will look at is, what has the business done in the past, and what are you saying that it's going to do in the future? The closer these two elements are, if what you're proposing to do in the future, or the similarity between what you're proposing to do in the future and what you've done in the past, will give more credibility to your business plan. If what you're proposing to do is completely different from what you've done in the past, your forecast can look great, but it will not be believable by most equity investors. So I think it's really around track record and the link between your track record and what you're going to do in the future.
Right. And so this just to school Samaila, Asari Evans, and then Osman from Nigeria. You asked questions that centered around Jerry's answer. So I think I'll only have to repeat your questions, given that he's just addressed it in this answer to the earlier question I posed. So I'm going to go to Chinedu from Nigeria. He's asking, if you started a business and your competitor's capacity is actually higher than that of your own capacity, how do you strategize to grow fast?
Now this is a very interesting corporate strategy question. The first question you should be asking is, and I'm going to go back to, I think the second point or the third point in the points I made about what makes a business attractive. Do you have a system and process in place to produce the products and services at a competitive price? Very important question. If you cannot answer yes to that question, you are probably in the wrong business. I know that's a very harsh verdict, but then you're probably in the wrong business. If your competitor has higher capacity, higher resources, then what are you doing something? Maybe you need to be in a different niche. Okay, so maybe to put it, to use a real life example, your competitor is producing normal tomato paste and they've got more capacity than you. Maybe should you consider producing organic tomato paste and focusing on that, or producing another product that your resources, your plant can produce? Because there's no way you're going to beat that larger, better resourced competitor at their own game. You need to be playing a different game. So in terms of strategizing, I can't give specific answers, but you definitely need to think about how you're changing the game so that you're doing something slightly different that is still targeting an established and growing market that is willing to pay for your product.
All right, so I'm taking this from Namveen Faden. He didn't indicate country. For the tomato paste, or with respect to the tomato paste business example, can't we collaborate with farmers by providing improved seeds that will give us more yield per hectare, therefore cheaper raw materials? In other words, I'm sure he's asking what are some of the solutions in going around that example?
Yes, you can. Now, this is where you can certainly do that. However, you need to think about timelines, right? So if you give improved seed and fertilizer to farmers, the Nigerian farmers or the Ghanaian farmers, from the example, this year, will they move from 7 metric tons a hectare to 65 metric tons a hectare by next year? That's a question. Or how long will it take for them to get there? Because the only way you can actually compete is when your yield is competitive with the international yields. So that's a core question you should be asking yourself before you put a single dollar into the processing plant. I would actually just focus on producing tomatoes first for probably 4 or 5 years and try to get my yields up. While producing the tomatoes, I have to establish whether there's a market for fresh tomatoes in my local market. If there is, then I'm using the first market, selling fresh tomatoes to the local market to feed my business, to keep my business going, even as I've got a long-term view on the processing plant business. But then my gating process, my decision milestone is when I get to 60 metric tons per hectare, then I'll start raising money to set up the plant. By the time the plant is up and running, I'll probably be at 75 metric tons per hectare, and therefore I know I can compete. So this is how we need to think about it so that we are phasing the investments in the right way and not putting money into things that have a very high likelihood of failure structurally.
Right. So there's Kabiru from Nigeria. He's asking, can an idea stage agripreneur have access in any way to finance from equity investors? In other words, can an idea stage entrepreneur access equity financing? And if so, what conditions would make that possible?
So I'll start with what conditions make that possible. Are there equity investors out there who want to invest in an idea stage business? All right. So going back to my quote of beginning with the end in mind, if you want to raise money for a startup, the first thing I'll do is start looking out there for investors that focus on startups. See how many there are, because this is almost, it's your market scoping, right? How many NGOs, funds, etc., state that they are interested in startups. Then after you've identified them, you figure out from them, because everything has to be on a case-by-case basis. And I think I really like this question because it also touches on another point around what a lot of us do as entrepreneurs. We generalize, right? So we want a generalized answer to a question, like what would it take for someone to put money into my startup? Start from who wants to put money into a startup and what type of startup do they want to put money into? Now, from that list of startups that they want to put money into, is there anything in that list that I feel like I want to do that matches with my values, my skill set, and my goals? If you approach it that way, you have a much higher chance of getting money into a startup than starting with an idea that you came up with and then say, okay, let me see if there's someone who can invest in this startup idea. All right, so really start from the end process. And I'll probably give you an example from my own experience in Injaro. When we started Injaro, our objective was to create, to be a private equity fund manager that would invest in several sectors. Now, these several sectors happened to include agriculture. So in a way, we made the mistake that I'm advising you not to make. We started off with our idea and we said, yeah, now let's go start looking for money. When we started talking to investors about giving us capital to manage, we found that most investors did not, we were a first-time fund manager. We had never run a fund before. We found that the only investors who were willing to give money to a first-time fund manager were the investors who were focused on agriculture. And they were interested in talking to us because we had included agriculture as one of the sectors we wanted to invest in. So, although we had made a mistake by picking our idea and then going to the market, once the market started telling us something different, i.e., if your fund were 100% focused on agriculture, it would be easier to raise money. What did we do? We changed our plan. So we said, okay, our fund will now be 100% focused on agriculture. Will you give us money now? And they said, yes. So we took the money, and that is how we built Injaro. And in many cases, I love these discussions because I am an entrepreneur like you. I came up with an idea, a startup idea just like you, right? And I had to go and face the market and see what the market would say to me. But it's very important to stay open-minded, listen to the harsh truths that the market tells you, and work based on those harsh truths. You're much more likely to succeed when you are working in tandem with what someone else has stated that they're willing to do, especially if that person is an investor.
Right. So then there's a question from KR Foods. Question is, as a startup, how should we approach anti-dilution provisions when negotiating a term sheet?
I'll say with pragmatism, right? Because any investor who comes into your business early in a Series A or pre-seed round wants to know that when the business grows, they are not going to get diluted and end up with, their returns being diluted. So pragmatism over here means, seek first to understand and then be understood. Don't just say, okay, I don't want, because anti-dilution works in two ways. You, the founder, being diluted, and also that equity holder being diluted. Now, in a way, it's a zero-sum game, because if you don't get diluted, it's either you get diluted or that investor gets diluted. However, you need to be pragmatic enough to ensure that the investor has a clear pathway to making a return. You remember that last step in the fundraising process? Ensuring a successful exit for the entrepreneur, for the equity investor. If you bear this in mind and actually brainstorm alongside them on how they can make a reasonable return, I think you will probably look at this question slightly differently, not as a zero-sum game, but as a collaborative effort at designing a structure that ensures that you, the founder, you have a pathway to making money, and the equity investor also has a pathway to making money. So I think approach it with open-mindedness and pragmatism. Am I still connected? It's gone quiet on my side.
Yes, Jerry, you are. Kindly
Okay.
Okay, so our next question,
Yeah.
Jerry, we have Peter Elias Umbunguna from Kaduna, Nigeria, who's asking that what happens after investing in a business and the government policy changes? Won't it affect the business?
It most certainly will. And in this presentation, I didn't talk about external factors that equity investors look at, but external factors are things that we look at all the time. So especially if you're investing in a business that is competing with imports or a business that benefits from certain government incentives, we always try to understand what the likely changes are going to be to these external factors. So if the government changes its policy, and this would factor into the investment decision as well. So an equity investor would probably look at your business and say, hey, I think there's a risk that this government policy will change. And if it changes, it will have this impact on your business, which would then result in your valuation falling. Therefore, rather than getting a 10% equity stake for my money, I want a 30 or 40% equity stake. This will lead to a discussion, and you guys will either agree or disagree. So if for instance, the investors of the view that the government policy change is very likely to happen, they will stick to their guns, and there might be a difference of opinion in terms of valuation. But yes, if the government policy changes, it affects the investment. Therefore, investors have to look very closely at possible changes in government policy. This is one of the reasons why in our internal assessments, we always conscious about elections. Even when we're looking at a business, we assess whether a company is seen to be affiliated to one political party or the other, what's the impact, what the likely election result is going to be, and whether that election result is going to affect that business based on the political leanings of the founder. These are all things we consider because they affect the business.
All right. So we have Raymond Oswansa from Ghana. He's asking, how should a startup deal with an investor who wants undiluted shares?
So you have to negotiate, right? So one of the things, and I'm sure you probably have another webinar for discussing the terms, etc. But one of the ways you could handle that is that you could set a condition, right? So you could, for instance, say that no dilution of the investor's shares unless an amount of more than $5 million is being injected into the business, at which point dilution would start, right? Because you don't want one investor who comes in early to prevent you from raising capital, all right? Because if that investor says, and I'll use an extreme example, that investor has 50% of your business and they put in only $1 million. And someone else wants to come in and put in $5 million, and they're saying they don't want to be diluted from the 50%. I think this is the kind of scenario that most people are concerned about. So that means you, the founder, now have to suffer a big dilution on your 50%. Now, what I would do in the beginning is say to the investor that, look, you put in $1 million. So let's say for the first $2 million that we raise above this, you will not suffer any dilution. But once there's capital coming in that is more than $2 million, then you're going to be diluted according to X or Y or Z formula. That is a negotiation of terms. And a reasonable investor will understand that what you're saying makes sense. So it is good to be knowledgeable on your end, so you can make rational arguments which will make the investor look stupid for not agreeing to. I don't want to really put it in those terms. They have to look like every investor wants to look like they're also a fair player. So if you can make the arguments as to why what they're proposing is unfair, like the example I gave, then they're more likely to switch their position, especially if your business is attractive. I'll go back to that point again. But for a startup, your leverage, is a lot lower, but it's still worth trying to get slightly fairer terms. And this would normally be based on the quantum of new investment that would trigger a dilution.
All right, so we have from Rockford, how would one convince an investor or investors in a business which is 100% reliant on consignment stocks? Rockford from Malawi.
I'm not sure I fully understand the term consignment stocks, but I'll interpret it to mean, I'm not sure I fully understand consignment stocks. Are we talking about a single client, a single supplier, or are we talking about a contract where a big company is contracted to buy all of your product? I'm not sure I fully understand consignment stock.
Okay, so I would appeal to Rockford to rephrase his question whilst we go on to the others. This is Iche from Nigeria. If your business has a good financial record and a positive cash flow streams, like you said, why then would such a business be asking for investors? Interesting question.
Well, it could be down to, and this is a it's a very interesting question, and actually, probably one of the more interesting ones to tackle. Now, because it cuts to the heart of the mindset of African entrepreneurs, or actually of many entrepreneurs, which is, if my business is going well, I do not need any third-party capital. You understand? Now, the question is this really true? My answer to that question is, it depends. So let's say you're running a processing plant that is operating at 90% capacity. It is profitable and business is great. Now you need to grow you want to double your factory capacity. So you want to put up a completely new factory, which will triple your capacity, but enable you to serve the same market. So this is a case where your historical track record is very similar to what you're going to do in the future. Now, in many cases in Africa, a bank is unwilling to give you a bank loan that stretches out for more than 2 years, or maybe for more than 3 years, in most cases. If you're fortunate, you might be able to get that. However, it's going to take you 2.5 years to construct that new facility. This is a classic case where what you need is, at the very least, a blend of equity and debt. You can't go for 100% debt, because you're going to take that 2-year loan, and the factory will not be completed before the loan. You have to start making repayments on the loan. And the old business, the existing revenues may not be enough to cover that loan, because they're trying to double or triple your capacity. In this scenario, you're perfectly positioned to go for an equity investor who says, you know what, I can give you the money, I can give you the majority of the money you need for that plant, and I don't need to see any money coming back to me for the first 3 years. Therefore, that is the right time to go and get that equity. Now, one thing that a lot of entrepreneurs do not do is look at the raising of capital as an opportunity to cement the leadership position or leapfrog their competitors. They only think about it in terms of, I've got enough cash flow, I can pay all my bills, why do I need equity investment? And if you only look at it in those narrow terms, you could be missing out on significant opportunities to become a market leader.
Right. So Bernard from Kenya, suppose a startup gets grants funding and fortunately almost immediately also gets equity funding down the line. Can it bring any conflict to the latter? And how can a business harmonize both to succeed?
Well, the real question is whether there were any conditions associated with the grants that you received. Because I think in my experience, most grants come with certain conditions. A grant could come with a condition that you sell your product at below market price. A grant could come with the condition that you hire more people than you need indirectly, but then they might say that they really want to help create jobs, so they want to make sure you have to make sure you've got 20 youth employed in your business all the time. The real question is whether those conditions, the grant might come with a condition that you only buy raw material from the United States of America or from a particular company. There are all these things that can come along with grants. So it really comes down to whether there are any limiting constraints associated with the grant that would be objectionable in the view of the equity holder. So you should be open about what those terms and conditions are, discuss with the potential equity investor and see if there's a way that they can be comfortable with those conditions.
All right. I'm going to try and present this question as clearly as it was stated. Adnan from Ghana is asking, wouldn't it be ideal to have a third party of experts who will work to support entrepreneurs to be successful and at the same time safeguard the interest of the investor?
Isn't that called the board of directors? If you structure a board of a company correctly, that is what the board should be doing. And this is why you need to have a board that has enough qualified, independent members who put the interest of the company first. And I have to be very clear about this. They put the interest of the company above the interest of the founder and above the interest of the new equity investor. They try to act as a fair arbiter that puts the company first before anything else. And in my experience, we have created boards like this. We actually always seek to create such a board when we make an investment. And on that board, when you have such a good board, what you see happening is that sometimes the founder's position will be supported. Sometimes the equity investor's position will be supported. Other times there'll be a blend of the ideas that come from both sides, which morph into something that nobody even imagined before. But that is actually better for the business. So this entity you're talking about, if properly structured, is what the board of directors is actually set up for. It is not created for you to put your best friend, your sister, your cousin, your uncle, your family members. That's not what it's for. It's to create an entity that will work in the best interest of the business and not for the interest of any one shareholder.
Okay, so we have Shaka from Nigeria. He's asking, if you have all the assets and installation in place, but only required some funds to get running in terms of sourcing your raw materials for your production process, how do you present yourself to an investor who has no knowledge of your business idea?
Well, all investors understand how money is made. In this scenario, do you have off-takers who have promised to buy the product? Do you have contracts with suppliers that prove that once you secure the product, the raw material at that price, and you process it at an economical processing cost, the off-takers price that they're paying is going to guarantee a margin? I don't need to know anything about your business to establish this. I just need to look at some purchase orders or some supply contracts. And then I need to look at the off-taker agreement that you have with that reliable supplier and a track record of what track record they have in paying people that price. And it's done. I don't really need to understand much else. Then the other risk is your processing or your production risk. It is our job as founders to make it easy for the investors to understand. It isn't for us to say these equity investors don't know anything. I wish there were more investors who understood our business. It is our job to make them understand.
All right. We have Bade from Nigeria again. Startups are discriminated on the basis of a knowledge gap by funding institutions in Nigeria. What should beginners do to circumvent this stifling hurdle? I think that's a combination of a comment and a question, I think.
Yeah, so I think my previous comment is, this is linked to the previous comment about the helping investors to understand. Because this current question, which says startups are disadvantaged because of a knowledge gap, which knowledge are we talking about? Is it an understanding of the business? If it is, it's the job of the founders, the company owners to educate the investors. But I would actually contest the underlying thesis of that question in that part of the reason that startups are not favored is because of the inherent risk in investing in the unknown. And this is why I'll go back to the fundraising process again. If the process for developing the business has followed the path that I suggested, checking the market. Do you have people who will buy the product? Start it on a small scale, using a bit of your own money, using some partners, you know. In other words, what I'm trying to say is avoid a situation, try as much as possible, avoid a situation where you're presenting a pure startup to investors.
Right. Okay, so I'm going to go back to Rockford's question. He's pretty much broken down what he means by consignment stock. He's pretty much talking about when the manufacturer actually advances the stock for you to sell, and then you only get at an agreed period of time, and then you only make money on the markup when you pay back. So the question was, how would one convince an investor in a business which is 100% reliant on consignment stocks?
Everything comes down to the viability of the underlying business. Who is buying this consignment stock? At what pace are they buying? At what price are they buying? If that consignment stock is flying off the shelves, I don't think he'd be asking me this question. Or if they have a track record of that consignment stock flying off the shelves, I don't think they'd be asking this question. Now, what is the issue over here? Is he trying to start big or rather than starting small? Because if it's consignment stock, it seems to me like you should be able to start on a small scale and prove the model. So start on a small scale with a little bit of capital and prove the model. And after you've proven the model on a small scale, then you try to raise capital to prove it on a slightly bigger scale and so on and so forth, gradually scaling up until you become big. But if you're trying to make a step jump from, 50 kilos a week to 50 tons a week, then it's going to be harder to convince an investor because you don't have a track record for moving the volumes that you're trying to get them to finance.
So Matthias from Uganda, we are a group of youth farmers in Uganda, and we would like to export fruits and vegetables. We have been able to source farmers on the ground with harvest. But our issue with the farmers we've been able to source farmers on the ground with the harvest we need. But our issue has always been the markets abroad. That's his submission question. Yeah.
So he goes straight to the core of the points of my presentation. That you see over here, they've started with the production, they haven't started with the market. Now, is it the investor's job to help you the market? No, it's their job. So they need to do the work to find the market outside. After you found the market outside, you might find several things. One, even the crops that you're proposing to produce, they don't want. And two, there might be some certain qualities and features of the product that you need to modify. Three, the form factor, the packaging in which that thing goes might need to be different. You don't know all of this, but you've already got to start producing. Spend time working on the market first. Understand exactly what it is that people are willing to pay for, that they're willing to commit to on paper, saying, if you do this, I will pay you for this. Once you've got that, then you go back and start backfilling to supply. In some cases, you might even want to start being a trader first, buying it from people who are already doing it to the standard required, selling it for a markup, making a bit of a profit, even as you're working on your own production, your own production model or system, right? So, yeah, it's a good question because it illustrates exactly what the big challenge is for early stage businesses.
So Lawrence from Tanzania, in terms of partnership or the co-founder, what's your take for an entrepreneur who develops an app and partners with a hardware company, but the hardware company doesn't take a share?
Well, when you say partner with a hardware company, what I hear is that you're paying some money for hardware.
So ideally, it would mean they have a software application, and then I think maybe the hardware for that software to run on might have to be on that particular platform provided by the hardware company, I think. But pretty much, it's talking about two partnership perspectives over here.
All right.
Along that same chain.
So let's go back to why an equity investor thinks a partnership is important. The equity investor thinks a partnership is important because it proves that you can actually be a fellow equity holder, a co-shareholder in a business with someone. From what I'm hearing, this sounds like someone who doesn't want to be in an equity partnership, but wants to create the semblance of being the kind of person who can partner. I could be judging, but I'll just go back to the objective. What we are looking for is there proof that you can actually be a partner to someone and thereby form evidence that I can also become, or you could also be a good partner to me.
Right. And then there's Bolato. This is an interesting question, I think. He's asking, is it necessary to be a degree holder to attract equity investors into one's business idea?
No. And again, if the business is attractive, you will get money. We've invested in Injaro, we've invested in businesses where the founder didn't have education beyond, I think, beyond third year of secondary school. And it was a good investment because at the time we went to look at we looked at the investment, the track record was there. It was making money, it was making a profit. At that point in time, do I care whether you have a degree or not? No. You've built a system that is producing a product or a service, people are buying it, you're doing it profitably. That's all I need to know.
Right.
Unless the degree is intrinsic to a service that you're delivering. If you say you're going to be, and even then, if you're producing the service and you're earning the money for it, no more questions. Would I go and insist that Mark Zuckerberg be a degree holder or that Bill Gates be a degree holder when I was going to invest in Microsoft, 20 years ago? No.
Okay. I think Todzum from Nigeria wanted to clarify the question he asked with respect to the discrimination on the basis of the knowledge gap. He said, the knowledge gap I'm referring to is the professional certification of the business sector. If my startup is in fishery, funding institutions demand for certification showing my knowledge of the sector.
And that makes absolute sense, because I think this is where, putting yourself into the shoes of the investor really comes in. The investor wants proof that what you are telling them will happen in the future is likely to happen. Now, if you're a startup, you do not own, startup assumes that you're not producing the stuff yet. You're not doing it yet, right? So the only proof, so I'm right now, even if I'm trying to help you, I'm scrambling to find evidence that what you say you can do, you can actually do, that you can do what you can say that you're claiming to be able to do. And that evidence has to come from third parties. Now, it's very different if this person is already producing the fish and they don't even have a certificate. In that case, as an equity investor, I'll say, yeah, I'll work with you to go and get that certificate because it's a legal requirement. But I can already see that you're doing the stuff and I'm going to help you scale up. All right. So it's all about evidence. Everything we do is evidence-based because remember, the money is not ours. I have to be able to answer the question, why did you go and give the money to this gentleman who didn't have a track record for doing this? What was your basis? I need to produce something. I can't say I went based on my judgment. That's not good enough for my investors.
All right. And so, Jerry, I'm going to take this question again because I'm sure you've already answered to it, but we've had several more others join in as we speak. And so for their benefit, I'm going to have to reiterate this. This Holt Prize from Kaduna State University. Abdul, what will you look for as an investor before investing in a startup that is a pre-seed company?
So, so the first thing I'll look for is, I'll look at the team that is proposing to do whatever it is that they're proposing to do. And I will look for evidence that this team has succeeded at something before. I don't care what it is. Let's say they want to start a I don't know. They want to start a farm, right? Pre-seed, I don't know anything about them. I'll say, okay, what have you guys succeeded at before as a team? If they've succeeded at something, then it means that they've already developed a culture, a system, and an approach to working together as a team to deliver results. That's the first thing I'll look at. Then the next thing I'll look at is, are there any similarities between what they succeeded at and the new thing that they're proposing to do? Right. Now, then we look at the gap. Then based on if there's a gap between what they've done before and what they're proposing to do, then we'll explore their openness to us introducing them to people, new team members, experts who can help them fill that gap. Then we'll probably, in due diligence, we're going to look for people who are experts in the sector that they're looking to go into, and I'll ask them, what do you think about me bringing in this team that has never done this before, plus these experts that I'm going to add on to them? what do you think the likelihood is of success based on your experience? These are all the questions I have to answer and get a solid answer for before I would consider a pre-seed equity investment. And that is even if my fund gives me the mandate to invest in startups. And this is another very important point. Half the time, entrepreneurs think that people like me are unilaterally making a decision that we don't want to invest in startups. Guess what? When we go and raise money from investors, some of them say to us, we don't want startups in the portfolio, or we only want 5% of the money to go into startups. Literally, they're giving you a red light, a warning flag that if you bring a startup, it had better be good. So guess what? Put yourself in my shoes and ask yourself, what do I do to prove to any investor that my startup is going to be risk-free or almost riskless, right? So this would then, I can probably segue that into an answer around what type of startup is most likely to raise money. Okay, so the type of startup that's most likely to raise money is one that is, let me probably use, what would be a good example? Let's say let's go back to tomato paste processing again, right? All right, so you've got 4 or 5 people who are working for Dangote's tomato paste factory. They decide to leave together to set up a new business, startup, and they're looking for capital. This team has been working together, running Dangote's factory for the last 5 years, generating profits for Dangote, which are independently verifiable. They come to me and say, hey, you know what? We've done this for Dangote for 5 years, but now we want to be our own bosses. Can you support us to start a new business doing exactly the same thing, but at a lower price than Dangote, so that we can also take some of the market share? Well, this is a kind of startup that has a better chance of raising money than one where it's a group of accountants who are leaving a big accounting firm. They've got a bit of money and they say they're going to start a startup and to compete with Dangote in tomato paste. So hopefully this is giving an idea of how an equity investor will look at these situations.
All right. Okay, so we're going to take a couple of questions and then we should pretty much be on our way. This is Kangoma Ture. If I'm producing one set of crops in my own capital already and want to go into processing with an investor's contribution, how would the profit sharing be? Will we share profits across? You want me to repeat the question?
Yeah, I heard the question, and I'll just reiterate again, put yourself in the shoes of the investor. The investor wants to take minimal risk and get a return for their investors, right? So I wish this were interactive so I could throw the question back at them. If I were the investor, I would definitely want exposure to the low risk part of the business, because that gives me a floor to my downside while being exposed to the potential upside that comes from the plant. So I'll take an equity stake in the combined business, for instance, so that even in year 1, if there are dividends being paid, I get some of the dividends from the old business, even as we're all waiting for the processing plant to be built and generate additional capital. But if you're trying to be a partner, it's almost like saying you're going to get married to someone and you say to yourself, okay, all the money that I'm earning before you come in I don't want to share any of that with you, but any of the money that you bring into the marriage, let us all share together. Think about it. If you think about it like a marriage and in those terms, it helps you really think about how you structure some of these discussions. And it's very important that how you come across in some of these discussions as well. Because if in an early meeting with an investor, you say to them, yes, okay, I want your money to build a plant, but I want you to be only linked to that risky part of the business, but not to this low risk part. Already you're telegraphing to that investor that you're not really someone who's looking for a partnership where everyone is sharing risk and sharing returns. So it's very, very important to think about this as a partnership where you're trying to win for everybody.
All right. So Lawrence from Tanzania is, what's your comment for a startup that wants to use the franchise model as a growth strategy in order to minimize financial capital required for scale-up?
I would say if you can find a good franchise brand, it is a great way to actually start a business, because I'll go back and say, because the process is there, the system is there, the raw material supply chain is there, basically, if you think about a business as a business system as having a number of components that you need to get right, when you use a franchise model, probably 9 of them have been defined, 9 out of 10 have been defined for you, and that leaves you the room to focus on the last piece, which I guess would be marketing and delivering the service. So it is a great way of entering a business in a low risk way, and gives you good practice in actually running a business in a disciplined way. That could probably be very good preparation for you to start the next business. And I think this kind of touches on me describing the fundraising journey as the entrepreneurial journey, and thinking about how you want to grow as an entrepreneur, and how you can structure that growth pathway in a way that allows you to, almost like riding a bike when you start with training wheels, and then you move on, you take off the stabilizers and you go onto 2 wheels. How can you structure your entrepreneurship journey so that you're learning while taking calculated risks along the way, and that's not just jumping into the highest risk model of the entrepreneurial journey. I think that's probably a very interesting way a very important way of thinking about the entrepreneurial journey.
All right, so I think I'm going to chip in my question, because we do have a number of agri-tech entrepreneurs on the platform, and I'm sure they would want to ask the question, but I may ask on their behalf. I noticed that Injaro, has Injaro actually made any investments in any agri-tech firms during its tenure? No operations.
No, not yet. We haven't, but we're open. So you can send us opportunities at any time. Which country? Well, anyway, they can send us opportunities.
Right.
They know how. I'm sure they know how to find us.
Fine, great. So I think we're going to close it here. This has been, in the words of one Maria Goretti, one of your trusted audience. Now, she said this webinar has been incisive and informative. A million thanks. And Jerry, if you could kindly just summarize once again what Injaro stands for and what you do for those who've just joined us, and your final words of advice to our faithful, loyal, and highly motivated AgroMinds community. So
Injaro is an investor of private capital. So we invest both private equity and private debt in SMEs across Africa. So we do this through an equity fund and a credit fund. So the credit fund is called the ABC Fund, and if you Google it, you probably find details for that on the internet. The credit fund has a long name, Injaro Agricultural Capital Holdings Limited. So that is what we do. We invest in SMEs, and part of our objective for doing this is not just to make money, but it is also to actually grow businesses that will contribute to Africa's economic growth. This is why we got into the business. And for this to happen, we need a lot of well-run, well-managed businesses that are thinking the right way about approaching the market, so that we don't waste a lot of resources chasing things that are not likely to work. It is in the interest of all of us as Africans to have successful businesses, because this is how we grow our economies, this is how we regain our pride as Africans, and this is how we create an Africa that people want to live in, rather than having our young people jumping into the Mediterranean trying to find a better livelihood anywhere. And you entrepreneurs are actually at the heart of making this happen. By growing these businesses that hire the majority of our people, you create the jobs, you create the hope, you create the livelihood right here that makes sure that Africans remain proud to stay right here in Africa and make their lives over here. So final tips: always start from the market and put yourself in the shoes of the investor. How do you make yourself attractive to the investor? And that always starts from ensuring that you have a viable market to service, and that you and the system that you create are able to do this in a price competitive way and in a sustainable way. So never forget about that. Always start from the market.
Thank you very much, Jerry Parks.
You're welcome. Thanks so much.